After abandoning Twitter, Elon Musk has caused big changes in the world of social media. And probably the biggest changes happened with Twitter, especially with the valuation of the platform. And in spite of the fact that Elon has been praised throughout social media platforms for his brave actions and for exposing lies about Twitter, there are a few people who are not so happy with Elon. And Elon is being sued by stakeholders of this social media platform because, as they explain, Elon deliberately tried to lower the value of the platform, and they have big plans to expose this action. With that, famous business moguls came out and critiqued Elon because, as they say, this is Elon's attempt to buy Twitter at a very cheap price. As you know, with new negotiations, the price of Twitter has been scaled in proportion to the number of bots on the platform. And Elon proposed a new bid, 75% of the original price. However, the Twitter board has refused this offer already. And now you may think that this is no big deal, but for the stakeholders of Twitter, this whole situation was not profitable financially. In a rather dramatic turn of events, Twitter shareholders have filed a lawsuit that accuses Elon Musk of engaging in what they call unlawful conduct, instigating doubt about his decision to acquire the social media company. The lawsuit claims that Musk had purposely orchestrated this entire scheme to bring down Twitter's stock price. This was hypothesized to either act as a ploy to walk away from the deal unscathed, or to have a chance at buying the company for much less than it was promised. The lawsuit doesn't come lightly though. It proposes that Musk waived off the required due diligence for his take-it-or-leave-it offer to purchase Twitter. This essentially implies that Musk chose not to look at the company's archival financial records, which is stretching things if we're honest. Stakeholders claim that the bots and fake accounts issue isn't all that novel. The company cleared nearly $810 million last year in dues to settle claims that said its quote for its growth rate and monthly users was not true. Conversely, things haven't been all rainbows and sunshine for Musk either. He has been auctioning off Tesla stock and shares. And according to reports, they have lost nearly a third of its value since the deal was announced on April the 25th to fund the acquisition. This has stirred up some legal trouble that concerns Tesla's shares. The Twitter shareholders' lawsuit proposes that Musk has been purposely disparaging Twitter, doing all he can to dishonor the non-disparagement and non-disclosure clauses of his part of the deal with the social media giant. If we look at Twitter's share price, which closed Thursday at $39.54, 27% below Musk's $54.20 offer price, that's catastrophic, isn't it? And if that isn't bad enough, the lawsuit says his eventual quote of the stake to the SEC was false because he employed a form that was intended for passive investors. But to clear it up, Musk wasn't at the time because it was being rumored that he would soon join Twitter's board and was interested in acquiring the social media giant. Musk profited by more than $155 million from his blunder to unveil his inflated stake on time. Since Twitter's stock price could be more, had investors been aware that Musk was planning on stacking his holdings, the lawsuit claims. Events would later develop into more grave legal issues, as the Securities and Exchange Commission would go on to publish a letter addressed to the world's wealthiest man, launching an inquiry of questions about how he publicly proclaimed his acquisition amounted to a staggering 9.2% stake on the 4th of April. This made a plethora of corporate activity set into motion that led to Twitter accepting a $44 billion takeover offer from Musk in late April. However, since then, the tech extraordinaire has put the deal on hold while he investigates the fake account Twitter demographic. In the 4th of April letter, the SEC asked why a regular 13G form detailing Musk's acquisition of a large shareholding does not look to have been filed and submitted within the 10 days of the stake going over the 5% level, where it needs to be shared publicly. According to Musk, he claims to have passed the 5% mark on the 14th of March, ideally having completed the form by the 24th of March. The letter also asks Musk to break down and explain why he issued a 13G in the first place, which is for passive investors who want as little influence in the business as possible, which is completely different from the ambitions of someone who wants to take over the multi-billion-dollar corporation. The SEC points out that an investor must issue a 13D if they have purchased the shares with the intent of influencing the company in question. The day after issuing his initial form, Musk refiled it as a 13D, as an investor who intends to take a more proactive role. But would this mean that Musk is going to be facing the brunt of some of these legal tycoons? Let's take a look. In the letter, the SEC asked Musk to provide a brief analysis and explain why he thought he could get away with a clause that allows passive investors to issue a 13G form instead of a 13D. The analysis also addresses tweets written by Musk, in which he publicly inquires whether Twitter rigorously adheres to free speech principles, implying that he does have a way to go about it when he comes in power that addresses the ethical framework of the company. But well, some people including Mark Weinstein, who also happen to be owners of social media platforms like MeWe, have been speculating that this is Musk's attempt to get a heavy discount of nearly 25% discount, which cuts the deal by nearly $11 billion. There's an argument that his offer is inflated, Mark said, and it should be adjusted to reflect the user revenue reality and the calculation for value based on that. In a recent research note, Wedbush analyst Dan Ives says the $54.20 a share offer was considered to be scrapped as more eyes were coming on the Twitter bot scandal. But if a new price can't be quoted down after negotiations, Musk will, unfortunately, have to pay nearly $1 billion in break fees. Ives has proposed that it's currently a solid 60% chance that Musk tries to shed the deal altogether and utilize this spam account scandal as the reason to get out of the deal gracefully. Whereas the chance that Twitter's board and Musk come to a new pricing throughout the next deal comes in at around 40%. The odds can be seen as clear as day. That new deal, Ives hypothesizes, would be near the $40 a share mark. However, Ives said that Musk needed to act quickly before Tesla and Starlink stock plummet again. Musk is facing a fork-in-the-road situation in which he has to decide his next step in this soap opera, as Tesla investor patience is wearing thin. And Elon Musk explained how he understood that they were lying about account numbers of Twitter, and the method Elon used for this was genius, and we talk about it in details in the video you can see right now, called Elon Musk's Crazy Revelation about Twitter Negotiations. That's it.